name is John Ripple, and I am a Canton SCORE volunteer. So this webinar is being put on by the Akron Canton SCORE chapter, so I hope you enjoy it today. Next slide.
Sorry, trying to get it to go.
That's okay. Sometimes it takes a second.
Yeah. I don't know why it's not letting me change the slide. There we go.
So for those that are not familiar with SCORE, SCORE is a nonprofit and actually has been around since 1964. Our mission is to help small businesses survive through mentoring and education. And no matter whether you're a business that's just starting up, or you're in the process of growing, or you're transitioning your business, SCORE is actually here to help you. So next slide. So as I mentioned, SCORE does have a mission to help small businesses survive, but the SCORE volunteers, they must follow a code of ethics. Can you go to the next slide?
Yeah.
I think that's where we talk about that. That's good. We must follow a code of ethics, including we cannot accept any money from any of our clients. Everything that we do with our clients is strictly confidential. We do not use any of our clients' data for commercial purposes, and the mentoring sessions are free of charge. So the SCORE is also a resource partner with the Small Business Administration. So if you can go to the next slide. There are currently over 200 chapters of SCORE across the United States. I believe we have right around, as indicated, around 10,000 volunteers across the U.S. And we are directly associated with the Small Business Administration out of Washington, D.C. So the next slide here actually shows our sponsors. They're helping our chapters out. You can read them. The Hoover Foundation, the Star Community Foundation, as an example. And we greatly appreciate these sponsors to help support our chapter, which in turn allows us to help you. So next slide. So if you do need to reach out, there is the QR code. You can take a snapshot of it or actually reach out to www.score.org, and we will assign a mentor to help you out. So before we get started with Sarah, there's a few housekeeping things I'd like to communicate. If you do have any questions throughout the webinar, there is a Q&A tab at the bottom of your screen. You can input your questions into the Q&A. Sarah is going to take a pause every so often to answer any questions that you may have. So feel free to write your questions in, and we'll bring them up to Sarah. Again, if you would use the Q&A tab, you can use the chat tab to communicate between yourselves. We prefer you not to ask questions in the chat tab. It helps streamline the process. This webinar is being recorded and will be posted on the Akron Canton SCORE.org website in the very near future. And you'll be provided a link to the webinar so you can actually view the webinar at your convenience in the future. So with that, Sarah, I'm going to turn the presentation over to you. So
Perfect. Thank you.
You're welcome.
Welcome everybody to Habitat 101. That's what I was about to say. I work for Habitat, so that's what I focus on a lot. But for Credit 101, a little bit about myself. I am the Family Partnership Manager here at Habitat for Humanity. I have been in the realm of credit, affordable housing, all that for about 10 years now. Started out being a housing counselor, working with first-time home buyers, trying to get them credit ready to purchase a home. And then now I'm at Habitat, and here I am the loan officer, and I also do the underwriting for Habitat. So really taking a look at all of our applicants' credit and things like that. So I've learned a lot about credit along the way in these past 10 years. And so I do have to share that while since I'm at Habitat right now, they do want us to share a little bit about Habitat with you as well before we get into the credit. So some of you have probably heard about Habitat for Humanity before, but our mission is seeking to put God's love into action. We bring people together to build homes, communities, and hope. And we do that through 0% interest mortgages. Habitat for Humanity East Central Ohio. So every habitat is independent. Our habitat in East Central Ohio, we do work in Stark being our primary county, but we do work in Tusk, Carroll, Harrison, and Jefferson counties as well. We build strength, stability, and self-reliance through shelter. So we believe that a home is the foundation for everything in your life, and so having that stability in affordable housing can really help you build on, a good life. We have built here at Habitat. We've been around for over 35 years now, getting close to 40. We have built over 670 plus houses in those 30 to 40 years. We're getting close to our 700th house. I think we will hit it this year. And again, we're selling houses. We are selling houses. A lot of people think that Habitat for Humanity gives houses away, but we sell houses at a 0% interest mortgage and no finance charges. So really helping people set up for success in home ownership. So how do we work with families? We work with families that are currently living in substandard housing, and there's that's kind of a broad range. So people who may have structural issues with their house, their rentals, people who are paying more than 30% of their income in housing. People who are overcrowding, so maybe they have, four kids and they're living in a two-bedroom house, things like that. So substandard is kind of a broad category. They do have to have a steady source of income because we are qualifying them for a mortgage. So that is part of my job, is making sure that they income qualify for this program. We work with people from 30 to 80% of the area median income. And then our families do have to be ready to partner, build, and invest with Habitat. So there is a 18 to 24 month commitment to Habitat, where they're completing a homebuyer education series. So we teach them how to use tools. We teach them how to maintain their house. We have a cleaning. We have a financial success class where I go over credit with them. I go over mortgages and basic budgeting and things like that. We teach lawn care and give our families lawn care equipment because now they're going to be homeowners and have a yard that they have to take care of. We have a foundations class, which is a personal growth and development class. Every Habitat homeowner does leave with a will as well. So when they buy their house, they will actually meet with a lawyer right after closing and put that will in place so that they have this big asset now, and we know where that needs to go. And then we also teach them about homeowners insurance as well, because that's a new product that they're going to have to buy. So that's Habitat. I don't know if anybody has any questions about Habitat at this point. Our housing applications are actually currently closed. They were just closed for the holiday season. They will be opening back up. So if you know anybody, or you or yourself or somebody that might be interested in buying a house with Habitat, check back on our website on February 1st. Look at those income guidelines and how to qualify, things like that. But we will be opening those back up very soon and looking for our next round of families that we're going to build houses with. So
Sarah,
this is,
excuse me,
yeah, go ahead.
there is a question in the chat um, on whether Habitat has the operations in Pennsylvania.
Yeah, so every habitat is kind of independent. So if you go on to Habitat for Humanity, the the main page for Habitat for Humanity, they have a finder, and you can put in your address, your city, your state, and it will tell you what Habitat covers that area. So we all are independent of each other. We all kind of work a little bit differently, but the main goal of Habitat is affordable housing, 0% interest mortgages, setting people up for home ownership. Any other questions on Habitat? All right. So, welcome to Credit 101. We're going to be talking about building, proving, and protecting your financial future. So, this is very basic credit information, and I'll get into a little bit of, what you need to know and maybe ways that you can improve that credit score and, help protect those finances. So, what is credit? So, credit basics. Credit is the ability of a customer to obtain goods or services before payment based on the trust that the payment will be made in the future. So, that's where that credit score, things like that come into play, your credit history. So, you'll get better offers if you have been trustworthy in the past. But not all credit is on your credit report. So there's the common types of credit. Everybody knows credit cards, car loans, student loans. That's a huge one and can be a big barrier for people when applying for credit. But there are some strategies with student loans as well of ways to put them in different plans and things like that to help your credit. Mortgages. That's what I've been centered around for my whole career is mortgages and getting people prepared to get a mortgage. It's probably easier to get a mortgage than it is a car loan, believe it or not, just because there's different programs out there. Personal loans, so those unsecured loans for various personal expenses. And then you've got your utilities. So utilities are a type of credit that isn't on the credit report when you're paying it, but it can show up on that credit report later if you don't pay it. So it is a form of credit because you're getting the electricity or the water or the gas before you pay for it, and then after you use your usage, you get your bill and then you have to pay for it. So it is a form of credit. Healthcare, that can be a form of credit as well. Again, it's not one that shows up on that credit report and reports as good credit, but if you don't pay a medical bill, it does show up on your credit report if they report it. So those are the different types of credit, common types of credit. A lot of people don't think about those, those other ones that aren't on those credit reports. So how do you find out your credit history? So there are the three main credit reporting agencies, Equifax, Experian, and TransUnion. Those three credit reporting agencies are just databases. So they get their information from those creditors. So the company that you have your mortgage through, your car loan, all those things, they're the ones reporting to those credit reporting agencies. Equifax, Experian, and TransUnion gathers all that data and puts it into a report. You can get your credit report from annualcreditreport.com for free. That is the only source of true free credit reports. It is set up by the federal government, so it's authorized by them. When it started, you could get one credit report a year per bureau. So one from Equifax, one from Experian, and one from TransUnion. Right now, I just went on right before this webinar, and things were changing with COVID, and there was a lot of fraud going on. So right now, it's still that you can get your credit report weekly, actually for free from annualcreditreport.com. Eventually, it will change back probably to being an annual report that you can get. But that is the source. There's other websites that are advertised that say they have the free credit reports. Usually what's happening is they're gonna have credit card offers or things like that. But this is the true source directly from the credit reporting agencies where you can get your credit report. When you log on there, you would go to each bureau individually, and you have to put in some basic information to verify that it's you. You're going to have things like maybe some past addresses. Obviously they're going to need your social security number, things like that. But that is the safe website to get your credit report. You do not get your credit scores, unfortunately, for free through this website. Each bureau does have a fee for your credit score if you want to know your true credit score. There are other places where you can get credit information that are valid. Like Credit Karma is a big one that people use, and it does have a score on there. However, that credit score is a Vantage score. If you look at it, it'll say, usually right next to it in small print, like this is, what score it is. And it's a Vantage score. And my next slide, I'll get into a little bit more about credit scoring models. But Credit Karma does have information that you can look at, your credit, what trade lines, things like that, things that are on your report. It is true and accurate, but that credit score that they offer you is not. Any questions on the credit reporting bureaus or how to get that credit report from annualcreditreport.com? Okay, perfect. So that credit score, again, Equifax, Experian, TransUnion, those are databases that collect and compile all the information that's reported on you from your creditors. So the credit.
Excuse me,
Oh, sorry.
Sarah. I'm a little delayed in coming back with the
Oh,
questions
no,
that
that's
are in the
fine.
Q&A. Okay, I'm just going to start at the top here. Deborah asked, can we contact you directly? And I imagine.
I cannot do individual credit counseling anymore, but if you go on HUD's website, you can find housing counselors, like what I used to do, that are in the area, and they do offer their services for free. And it'll tell you what kind of services they offer. So some have the first-time home buyer, some have just credit counseling, some have rental counseling, things like that, foreclosure prevention counseling. And they work individually with you, one-on-one, looking at your credit report and seeing ways that you can improve. But unfortunately, I can't do individual credit counseling at this time.
Okay, next question. Felicia says, I was told that medical is not allowed to report negative. Is that true or false?
So, yes, it actually can. It can report as collections on your credit report. A few years ago, different administration in the White House, they had actually limited the amount of medical information that could be on your credit reports. So they put a monetary value on it, and I believe the collection had to be over, I think something like $4,000 for it to show up on your credit report. Unfortunately, that policy has been reversed, and now I am seeing some smaller medical collections on credit reports again. So it had been, for a while that they took away that medical collections off the credit reports, and they are back on, unfortunately. I think there might be a smaller threshold now. It might be that it has to be, I think it's somewhere around like a $500. If it's less than $500, it won't show up. But if it's over, it can. So yeah, it was off for a little bit, and they are unfortunately back on.
Next question, I think you already answered this, but how accurate is Credit Karma?
So Credit Karma is accurate for the trade lines. So for the things, so a trade line is just like the information on one credit card. So each credit that you have will show up as an individual account on your credit report. That's called a trade line. So when you're looking at Credit Karma, what is reported is accurate. That information is accurate, but the score that they have on there is a Vantage score model. So credit scoring, everybody's using the FICO pretty much. It's kind of shifting a little bit where some lenders might be starting to use those Vantage scores. It's just a different credit scoring model that isn't as widely used. If you've heard of FICO, that's the standard, and I'll get into that a little bit more too.
Why don't the three bureaus match with the score?
So the bureaus create their or they don't create the score. They calculate the score. Each bureau calculates the score in separately, but each credit reporting agency isn't the same because not all creditors report to all three agencies. So each of your credit reports are different. Um, because say you have a Visa card, that Visa card can decide, I'm only going to report to TransUnion. Or you might have a car loan and it says, I'm going to report to all three. Creditors do have the choice of who they report to. So every credit report can be different. Now you might have all creditors that report to all three, but you might have some creditors that report to different ones. So the Experian, Equifax, TransUnion are just going by what's been reported to them individually. So they calculate your scores through each bureau. So that's why you've got the three scores.
Okay. And there are a few more questions, but I'm going to, first of all, I think some of these will be answered in your
Yeah,
presentation, and if not, we'll come back to these.
perfect. Yeah. So credit scores. Credit scores are just a numerical representation of creditworthiness based on your credit history. So that credit reporting agency is going to look at what's on that report and calculate out your score. I'll get into that, what goes into that on the next slide. But they use that, and it's how likely you are to repay your debts. So they go on the past, what you've paid in the past. So the FICO score, again, is the industry standard. 90% of lenders are using that score. It does range from 300 to 850. I have never seen either in 10 years. I've never seen a 300. I've never seen an 850. But it is in that range. So the higher score equals your higher risk or lower risk. So your high score, lower risk. So if you've got a credit score in the 800s, you're pretty likely to repay those debts. And that lender was more likely to then give you a loan, and then at a lower interest rate usually. If you are more of a risk, your interest rate's going to be higher because they think at some point you might default on that loan, but at least they've collected some of their money back with that higher interest rate. So the FICO score, that's the standard. If you look at your credit card statements, sometimes they have a score on there. Generally, those are not FICO scores either. It'll say Vantage. It'll say what scoring model it is. Some do offer the credit score for free on the statement. You just got to look at it and see what it says. Now, the Vantage model, it's probably pretty close to your score, but it can be off just because they are using different data, different methods of calculating that score. So FICO scores are what we're looking at. That's what I look at when I'm calculating or out mortgages and the risks for borrowers. So the FICO credit scoring model, this is what impacts your credit the most. So there's proprietary information in credit scoring, but this is what is known about the FICO credit scoring model. So the biggest part of your credit score, again, is going to be your payment history. So how have you paid your loans and credit cards in the past? And the biggest thing that matters is the biggest factor is how you've paid in like the recent history. So like the last year, year and a half, things like that is what they're going to be looking at. The older a late payment is on that credit score, the less it's going to affect your credit score. So that's 35% of your score. So a huge part of your score is looking at how you've paid. And when you're talking about late payments in the credit world, a credit payment has to be over 30 days late to count against you on your credit report. So if you pay your credit card 5 days after the due date, that's not impacting your credit score. The credit reporting agencies would never know that it was late. It's once it hits 30 days late, so a whole month behind is when it hits your credit report as being a late payment. And then the later you get, the more it's going to affect your score. Late payments can drop your score automatically, 20 points, 40 points, just in 1 month with late payments. So paying those bills on time is the biggest factor in that credit score. Next biggest factor is how much you owe out in credit. So, um, you know, optimal usage for credit cards is 30%. So you're not charging more than 30% of your credit limit um, to get the most points on your credit score. So what they're looking at is how much available credit do you have and how much have you utilized that credit. So that's a huge factor in your score. So if you've got your credit cards charged all the way out, they're maxed out, um, it's really going to take a hit on your credit score. That's going to really decrease that credit score. But as you pay them down and the more you pay them off, it's going to help raise that credit score. So then the smaller factors in there, so the 15% is length of credit history. So having loans or credit cards that you have had a long time is really going to help your score. So the longer you've had a credit history with a certain creditor, the more it's going to help your score. So that's why it's a good thing to not close out credit cards that you have available. The best thing is to pay them off, keep them open. Sometimes you're going to have to use them every so often, charge it something small, pay it off when the bill comes, keep that credit open. 10% is new credit. So I know a lot of people worry about inquiries on their credit report. That's a huge one. I don't want to take a hit on my credit. And it's not a good thing to open up a lot of new credit. But it's a very small factor in your score, and what really makes creditors nervous or what really starts impacting that score is going to be when you're opening up several lines of credit at once. So a big thing for this is if back to school shopping time, right? You're going to a lot of different stores. They're offering you a lot of different credit cards so that you can get a percentage off at the store that day, right? It's going to impact your score if you do that. I don't have the slide in it in this presentation, but store credit cards, if you really look at what you're saving in one day versus how much those credit limits are, or the percentage rates, the interest rates on those, you're not really saving anything unless you pay that bill off immediately when you get it. And then again, if you open up multiple store credit cards in one day, it's going to be a red flag, and that can decrease. That's where those inquiries and new credit start affecting your credit score. Other thing with inquiries, if you are shopping for a car loan or a mortgage, when you shop for a car loan, if you're at the car dealership, they're going to send your credit out to 10 different banks to see who is going to give you the best offer. When you're shopping for mortgages and car loans, you do have a rate shopping window of 45 days where all of your, those inquiries, it's going to be listed on your credit report separately so you can see who all checked your credit, but it is only going to count as one inquiry. So you do get a rate shopping period for car loans and mortgages. So you want to make sure you do shop around so you are getting the best interest rate that you can get. And then 10% of the credit score is a credit mix. So what they like to see is that you have a good, healthy balance of, installment loans, credit cards, if you have a mortgage loan on there, things like that. Having different types of credit on your credit report does help your credit score. So if all you have open is a car loan and you don't have any credit cards, you can get a credit card. It'll help boost your score. Or vice versa. Say all you have is credit cards and then you get a loan. It helps boost your score. I'm going to pause here for questions on the FICO credit scoring model.
Sarah, this is John. There's kind of an interesting question. It says one of my retail credit card account was closed because I did make a purchase within the year. I also had an account I paid off but did not close, but was listed on my report as closed versus paid. How does
Yes.
a closed account affect their score?
So the closed account, once it's not reporting anymore, it still has that credit history on there. From the date that something closes, it's still on your credit report for 7 years. But you no longer have open available credit. So when it closes, it decreases the amount of available credit to you, so it impacts that amounts owed category. Um, Store credit cards are one of those things that they do close them pretty fast if you don't use them, but you don't want to use it just to keep the credit card open. So it's better to have, like a Visa, MasterCard, something that's just a credit card, not tied to anything that you can have open, and maybe just used for something small, pay it off, then keep it open. But store credit cards, in the other trade line that closed, it might have just been from due to inactivity too. Every company is going to be a little bit different of how long they'll keep it open when you haven't used it. So it is beneficial to, like, when you have those credit cards, especially if you've had it a long time, to use it for something that you would already buy and then pay it off. Don't go buy something that you didn't need, just to keep that card open.
Sure, it makes sense. So is there a way to consolidate debt across multiple credit cards?
There is, I mean, there's debt consolidation loans. Usually those, it will have an impact on your score, but then in the long run, it may be better for you, because what those usually require, unless you have a really good credit score, if you're doing a debt consolidation loan, they're going to pay off your credit cards and consolidate into a loan that probably has a lower interest rate than your credit cards. But they are going to require you to close all those credit cards because they don't want you to use them again and then, be in the same predicament again before you have that loan paid off. So they don't want you to get over your head. So usually debt consolidation loans will make you pay or close those credit cards, as part of the deal. So it's going to close your available credit. It's going to decrease that score. But if you're already struggling to pay those credit cards or you've got high interest rates, it may be a great strategy to rebuild that credit.
Interesting. So we may discuss this a little bit, but I'm going to ask it anyways. It said that the person would like to close their credit cards, and they put in bold now, because they have a monthly fee. So assuming that the credit card has a monthly
Yes.
fee, and they're looking at purchasing a home in 2027, and they're
Mhm.
wondering how this affect their credit.
If it has a monthly fee, you definitely want to get rid of that. You don't want to be paying just to have a credit card. Before you close it, though, I would recommend maybe shopping around to see if you can get another credit card, just to have an open trade line on there. That is important. So, there's a great tool online that I use when looking for different offers and things like that. It's called NerdWallet. It's a great website. They are trying to sell you things. Just take that with a grain of salt, but they do have great data on there. So you can shop for different kinds of credit cards, maybe one that has a 0% balance transfer offer. Those have been a little bit more scarce recently because interest rates have been so high. But it might have a low introductory rate, things like that. If you know you can be responsible with credit, maybe looking at a cashback card. If you know, I will definitely use this card and pay it off, but then I get cash back, things like that. So if you use it for only for purchases that you would already make, like groceries, gas, things like that, but you're going to pay it off when that bill comes every month. You can look at different offers like airline miles, things like that. But it'll even tell you can put a little bit of information on yourself, like what your credit score is, maybe an estimate of your credit score, and it'll tell you if you're likely or unlikely to be approved for the credit card. So that was NerdWallet. That just is the great tool for financial products. They can even help you look for high interest savings accounts, that you can sort by is there a minimum balance requirement? So knowing how much money you have that you could put in that account, or any other restrictions on those. So that's a great tool, that I recommend people look at. Again, they are making money by you clicking on those accounts and opening them, but it does have the tools for looking for different financial products.
Fantastic. That's all the questions for now.
Perfect. So common credit myths. Checking your own credit score can lower your score. That is untrue. So if you go use annual credit report and get your credit score, that's not an inquiry on your report. It's not going to lower your score. If you go to something like a HUD housing counselor and do some credit counseling, they pull a soft pull of your credit report. So that also does not affect your credit score at all either. So having the knowledge is beneficial, and it's not going to hurt your score by looking at your own credit report. The only thing that's going to cause that inquiry and can lower those scores is those hard inquiries from lenders. And again, that's when you open a lot of credit. Maybe one inquiry, might have a very small impact on your credit report or the credit score, but opening a lot at one time is definitely going to affect that credit score. Another myth. You must carry a balance to build credit. That is untrue. You can build credit by using a credit card and paying it in full each month. So you don't need to leave a balance on there every month to build the credit score up. So you can use that credit card and pay it off when it comes, and it'll still report to the credit reporting agencies as a good positive account. You've paid it on time, so you've got that on-time payment to help the score. Having the open available credit so that amounts owed, that's going to help the score. But keep those relationships open. And the longer you have them open, again, it's going to help build that score because then you have a nice long credit history. Closing old accounts helps your score. That is untrue. That can actually hurt your score. So it reduces your credit history length and the available credit. So you want to keep those accounts open as unless it has something like that fee that you're paying every month. You don't want to pay for that when you can get a credit card where you don't have to pay a monthly fee. Any questions on myths or anything similar to that? Anything you've heard? Anything that I might be able to answer? Those are some common ones that I hear a lot.
Sarah, there is a question that I missed, and I actually had to look it up. And they're questioning derogatory credit, and can someone bounce back from a derogatory credit, which I've never heard of before, but I'm getting educated.
Yes. Yeah. So, derogatory credit, things on your credit report, that would be things like late payments, things going to collections, things like that. They stay on your report for 7 years, 7 years from the date it was closed. So that's another benefit of checking your credit report because, again, they're just databases. They can make mistakes. So it might already be 7 years past when that closed. Say it's a really old credit card that you had gotten into some trouble with before, but now it's closed. And it's been closed for 7 years, you can ask them to remove that trade line from the credit report. Now, if you have a positive account on your credit report, so something that you had paid on all time, say an old car loan that you paid in full, but it's been on there for over 7 years, you don't want to ask them to remove that. So I'll get into a little bit about disputes and things like that on the credit report, but yeah, derogatory accounts stay on there for 7 years. Now, if you file bankruptcy, that is something that will stay on your credit report for 10 years. So it's just a little bit different. Everything else is 7.
Okay, thanks.
Welcome. So how can I improve my credit score? Review your credit report and dispute any inaccurate information. So going on annualcreditreport.com, pulling those reports from each bureau, really review them down to the last detail. So you want to make sure you look at every trade line, make sure it's a credit card or a loan that you recognize. You want to look at the collections. I do not recommend disputing everything on your credit report, which is what a lot of credit repair companies do, because for the most part, what's going to happen is you'll dispute it. And then if it's a valid collection or credit card that you had, it's going to remain on your report. They're going to come back and say, nope, this was a valid credit debt. So don't just dispute everything on your credit report. That also makes lenders nervous. So if you go on and you dispute everything on your credit report that is valid, lenders do not look at that very favorably. They look at it as you were trying to get out of your debt. But if it is inaccurate, if it is something that you don't recognize, it wasn't yours, you want to dispute that for sure. You want to look at your name, all the addresses that are listed on your credit report. So there's a section of information about you. If there's addresses that you've never lived at, you don't know why it's on your credit report, dispute it. That can be indicators for fraud. So you want to make sure you take off any addresses that you've never lived at. There's going to be a section that has aliases. So a lot of the times, usually what's in there is women who got married, their maiden name. That's accurate. You know, that's something that you have gone by. But if there's any, you know, say they spelled your name wrong, again, that can be something that indicates maybe possible somebody tried to open an account in your name. So you want to dispute that. Just anything that's inaccurate on that report, you want to dispute it. Again, if it's something that's over 7 years old and they haven't taken it off yet and it's negative, dispute it. Pay on time. So pay those credit card bills on time. Again, on time means not more than 30 days late. So once it's 30 days late is when it impacts it. So you might get a late fee if you're, 2 days late, but it's not going to show up on that credit report. So pay them on time. That is the most important factor, especially if you're looking at qualifying for a home loan, car loan, is having those on-time payments. Having bad credit costs you so much in the long run. The lower your score is, the more you're going to pay in an interest rate. Pay those bills on time. Try to really work on that score. Again, decrease the amount of your credit card debt. So really focus on paying off debts. There are some great strategies for paying off debts. There's this snowball method is a great one. Snowball method is where, maybe you have 5 credit cards. What you want to do is you want to focus on paying off the one with the smallest balance. Once you pay that credit card off, so what you would do is with, those other 4, you've got 5, you take those 4, you pay the minimum payments on those, and then you really focus on getting rid of this payment on this card and pay this card off. So then what you do is you take what you've been paying on this card and you add it to the minimum payment on the next highest balance card until you have that one paid off. But you continue to pay the same amount in debt payments that you can afford until all 5 of them are paid off, or paid down, But that's one of the strategies for paying down credit cards is that snowball method. Big factor in credits is collections. So having those negative accounts on there. So that's, that can be you didn't pay a utility bill, you didn't pay a cell phone bill. That gets reported as a collection. The debt was sold, it gets sold to a collection agency, and now it's a collection on your credit report. Or say you didn't pay a credit card, what usually happens is that credit card company then sells the debt to a collection agency, and they put it on the report as a collection. So you want to work with collection agencies to pay off the debt. Collection agencies do buy the debt at a very low amount. So say there's, $1,000 in debt, and they bought it for $600. So something like that. It's a lot lower than that, really. But they're buying it for a lower amount. So what you want to do is call those collection agencies and try to make settlements on the collections. So you can start with like 50% of the debt. So if you have a credit card or a credit account that has maybe a $500 collection on it, call and offer $250. See if they will accept that to get rid of the debt and bring that negative credit down to 0 on your credit report. Now, that collection is still going to stay on your credit report, but it'll show that there's a 0 balance on it so people can see that you paid it off. You can try to negotiate with a collection agency, and sometimes maybe you might have to pay the debt in full or, pretty close to it, and request that collection agencies stop reporting it to the credit reporting agencies. There is something called a goodwill deletion that they can do, which would be taking it off of your credit report. But you really got to negotiate for those things. And they might not be willing to do it, but getting that collection down to where it's a 0 balance is a win. Negotiate. So say you have credit card companies, maybe those credit cards are past due. Maybe you've got late payments, you're 90 days behind, things like that. Or they are in charge off status. So that means they're not letting you use that credit card anymore. And you still owe the debt that's on it. So what you want to do is call them, negotiate, see if you can pay off the balance, to get the card back in good standing and reopen so that now you have that open available credit to you again. The thing that makes this positive about that is because now you've got that, the balance back or the credit line open, that open available credit to you, but you also have the history with that company that'll stay on the credit report. So that's a good strategy too. And then so say maybe your credit score is pretty low. You've had some rough times in the past, and you don't qualify for a regular credit card. You wouldn't be able to just get approved for a credit card to try to start having an open active trade line building your credit. You want to open a secure credit card. So secure credit cards is a credit card where the credit limit is based on an amount that you have in a savings account that you can't touch. So you would go to a bank, you would put the money in a savings account, and then they would give you a credit card with that limit. So it might be $500. So you put $500 in the savings account. Now you have a trade line that's open, available credit to you, and it's backed by that account that you have there. So those are a little bit lower risk because the bank already knows or that creditor knows that that money is sitting there. So if you default on the credit card, they have that as backing. So they're a lot easier to get approved for. So you can also shop around for those, look up secure credit cards and see like what if your score is maybe a little bit lower, what you could be approved for. Those generally they may have an annual fee, but you can find ones that don't. And that really will help build that credit score if you're starting from like a really low spot, and can't get credit cards from, a traditional creditor. Credit cards, unfortunately, are the best way to build your credit. It is good to have some loans in the mix too, but credit cards, what they have is that credit limit that has that open available credit to you. Whereas when you take out a loan, you borrow, $5,000 to buy a car, you're at your credit limit from the beginning. So that looks like a maxed out trade line, right? So until you start paying it off, and then you have some open available credit, even though you can't use it, you have that available, and that's reporting on your credit report. So loans do not help build credit scores as well as credit cards do, unfortunately, because then what also happens is you pay off the car loan, or your personal loan, and then it closes, and then that trade line is now closed. So credit cards can be open for an extended period of time. They've got that credit limit for you, so that gives you that open available credit, and that's what really helps build your score the most. Questions on any of that?
Well, Sarah, this is John again. Everything you've mentioned here is I find very fascinating. But there is a question on it that if a person pays their credit card in full before the statement closing date each month, will that cause some sort of a red flag within the creditors?
No, it doesn't. It just, and here's the thing about credit reporting is that the statement date and when they report to the credit reporting agencies can be a different date. So the cycle is not going to be the same. But paying it off in full every month it's not a red flag. It shows responsible use of credit. You might get a few more points if you leave a small balance on there, just that shows that it's being used, but it's not a red flag paying off the credit cards every month at all. But what we see, so on my end, when I look at a credit report, what I'm going to see is the trade line. So it'll tell me who the creditor is, when the account was opened. It shows me the payment history, so it doesn't, I do see how much is paid every month. But what I'm really looking at and what is the payment the payment line that shows if the payment was paid on time. So there's a line on the credit reports, and you would see this if you pull an annualcreditreport.com. It's going to have a line with the payment history on there, and it's a series of numbers. So you want the lower numbers. So it's either going to be, so it'll have one number for each month. So if it's a 0 or a 1, that usually means it's paid on time. The higher that number is, the more late it is. So if once you get to like a 2 on that payment history line, that means it's 30 days late. 3 is 60 days late, and a 4 is 90 days late, and so on. So the higher the number, the less on time it is, the later it is.
Interesting. So there's a person out there that's in the midst of deciding to relocate, and they're trying to make sense of what's the right thing to do. Should they go back to renting again or purchasing a home? And will purchasing a home be one of those purchases that impacts their credit negatively or positively in the long run?
In the long run, so short term, it's going to negatively impact your credit. Your credit score is going to go down anytime you take on a loan. Anytime you take on a loan or pay off a loan, the credit score is impacted and the score goes down, unfortunately. But over time, having that mortgage loan is going to, it helps build credit. Those are long-term loans. So you're in that relationship with that creditor for a long time. So it builds a nice long credit history. And as you pay down the balance, it's going to help improve that score. Plus having the on-time payments every month helps the score as well. So short-term, negative, long-term, very positive.
Okay. And then another interesting question dealing with medical bills where they're having a dispute with the insurance company, but they're being obviously charged for a payment that they don't feel that they have to make. And will that affect their overall credit rating as a result of not paying that bill?
It's going to depend on whether or not they're going to report it to the credit reporting agencies or not. So if they do, you can try disputing it, and that, this was supposed to be paid by my insurance, things like that. I've had people go back and do that as well. So it can, if you don't pay it and they report it to the credit reporting agencies, but you can try to dispute it and say, this was supposed to be paid by my insurance. This isn't my responsibility, and see where that goes.
Okay. I know you mentioned about maybe disputing some of the items that are on your credit score. This person is asking if you can just kind of explain that again on how often or really should you do that?
Yeah. So disputing the things on your credit report, you have to go to each credit reporting agency that it's on. So if it's on all 3 reports, you'll have to do 3 separate disputes. And you go to, the credit reporting agency's website. So Experian.com, TransUnion.com, Equifax.com. And it'll be right on there, file a dispute. And then it has a form you're going to fill out. And then they will respond to you. So that's a process. It does take a few months to start that process. But then they're going to respond to you. If you file a dispute once and it comes back that it's valid, you're probably not going to get it off your credit report at that point. But so it's a one-time process, but you're going to need to do it with each credit reporting agency that it's on. So you pull that credit report from the agency, and then you look at what's on each report. And then, I would recommend printing out your credit report, right on it, like dispute, like this isn't valid. I want to, highlight it. And then you want to go on and file those disputes with each bureau. And then again, it's going to be a process. They investigate. You have to give them some time, and then they will respond to you, and you will get the answer directly from that bureau.
Okay. And there's one more question for now. It says, what's the best way to build credit if you're just starting out? And this person says, I thought it was by leaving a small balance. Is that true, or is that a myth?
So you're going to want to start with a secure credit card.
Hmm.
You already have, or if you have a credit card open, and use it every month, pay it off when the bill comes. You might get a few extra points if you do leave a smaller balance on there. It shows that it's active, but you can get just, you can get points just by having it open and paying it off every month. So
Okay,
I would recommend, charge a tank of gas every month.
Mhm.
That used to be smaller than it is now, but with gas prices, but
Yeah,
charge a tank of gas every month, pay it off when the bill comes, and that'll help build that credit. And but yes, starting with credit cards and a secure card, if you can't get approved for a regular, a normal credit card, is going to be your best bet. That's going to be the first place you want to start, and then you build from there.
yeah. It's kind of interesting because on a personal side, yeah, I pay off my credit cards each month. I have two primary cards, and I notice my score fluctuates somewhat in it. And I've heard that it has to do with the amount of credit balance that you have on your card.
Yeah, I mean that balance matters a lot. That's 30% of your score is going to be how much, the utilization of your credit score or your credit, available credit. So, um, you know, you want to keep those balances. If you're going to carry a balance, it needs to be at least 30% or less of your available credit. Okay.
Gotcha.
So-
Thanks, Sarah. That's all for now.
Okay. So protecting your credit, that's also really important. So monitor that credit regularly. Again, right now you can check your credit report once a week through annualcreditreport.com. But if it goes back to yearly, my recommendation is so that you can get those free, accurate credit reports is to pull one bureau every 3 months or 4 months, every 4 months. So you'll go and you would start maybe, I'll pull my Equifax in January, and then I'm gonna pull the Experian in 4 months, and then I'm gonna do the Equifax, Experian, and TransUnion. So you want to pull them at a regular basis. Again, right now you can get them weekly for free, so you can kind of check them as much as you want. Credit doesn't change that quickly. But if you really want to monitor it, check it regularly. And then if and when that changes back to you can only check it for free one time a year, spread it out over the year. Um, you can freeze your credit as well. If you're not applying for new accounts, you're like, I'm not opening any credit cards, I'm not opening any more loans. You would go to each of the bureaus and put a freeze on your account. Um, Now what you want to do is if you're like, all of a sudden you're like, oh, I need a new car or something like that, you will need to go and unfreeze that credit, or when they go to run your credit, they won't be able to access it. Um, I have that happen sometimes here at Habitat. I have to call people. Unfortunately, we have to pay for credit reports even if it's frozen. All creditors do. We have to pay for a report even if it's frozen. So you might have to, if there's an application fee involved, you might have to pay a second application fee if you forget to remove a freeze when you go to apply for credit. There's also fraud alerts that you can put on your accounts as well. So freeze would mean no accounts are able to be open until that is removed off of your credit report. You want to do it with each bureau. You can put a fraud alert on your account on each of the bureaus as well, which would be different. And if you do a fraud alert, you'll provide a phone number and they have to call you. The creditor would have to call you at that number to verify that it is you trying to open that account. So there's those two available. A freeze is just a little bit more secure than a fraud alert because nothing can be opened in your name when that freeze is in place. Watch for scams and identity theft, and these are growing. These are huge. Um, it- they're getting harder and harder to spot. We had at Habitat here that somebody spoofed the phone number for our CEO and contacted one of the employees by text message through that phone number, and was asking for credit card numbers. Or they actually asked them to go buy gift cards and then to give them to her. But the fortunate thing for us is that we're a very small company. She just walked next door to the CEO's office and said, "Hey, did you text me asking me to do this?" But they do get harder and harder to spot. So watch for scams and identity theft. Unless you are standing in front of a bank teller, the bank is not asking you for your account number, and usually they're not even asking for that unless you're filling out the little slip at the bank. Generally, they can look up your accounts by the last four of your social and your name, but don't even give that out until you're on, you've called the bank yourself, and you have the right number, or you're standing in front of the person right there. Don't give out any information that you do not have to. Um, and use strong passwords and secure devices. So making sure that you're not using the same account password for all things, or something that's easy to guess. You don't want to use your name, your birth date, anything like that in your passwords because they will try that first. So making sure that those strong passwords, and if you use your cell phone, your cell phone will suggest a strong password, and you can use that and just have it store it so that it's something that nobody'd ever guess because it's a random string of letters and numbers. But your device will store that for you. So, you just really want to make sure that you're protecting that credit at all costs. So monitor it, freeze it, put a fraud alert. Don't give any information unless, again, you have called that company yourself. And then those strong passwords are really important. And don't ever give those out either. Important resources, again, annualcreditreport.com has the true source for free credit reports. Again, if you want your true credit score, they do charge a fee, each of them, to obtain that. Does not hurt your credit either. But usually I think it's around $7 to $10 for that actual credit score through each bureau because they are individual. myfico.com, that's where you can find updated information on credit scoring information, the credit scoring model. Again, that's going to be the FICO score, that one that's used by over 90% of financial places. Times are changing. Eventually, we might get to using those Vantage scores, but the FICO score is the most accurate, widely used score right now. And then ftc.gov/credit, credit rights and dispute information. So if you want to know, say you're not getting anywhere with a dispute or you're not sure how to file it, you can go there and look up your rights as well. So some of those questions with the medical bills and things like that, know your rights and go on the ftc.gov website and find out, solutions. But individual disputes, you can start those with the credit reporting agencies. So there's just some really good resources on credit. And that's all I have. So any questions? Any final questions?
Let's see, Sarah, would selling your house lower your credit score?
So unfortunately, it is going to remove that trade line from your credit report. So it will impact the score by closing that trade line. So anytime you remove a credit line or anything like that, it does negatively impact your score. You'll rebound from it, and you'll have other things that will report to the credit reporting agencies. Making sure you have open, available credit will help, but there's always an initial shock when you close any trade line. Unfortunately, like when you buy or pay off a car and buy a new one, if you do it right away, you're closing one trade, opening another one, so that'll have a negative impact on your score. As you pay down the new car loan, it's going to improve that score. If you sell a house and don't buy another one, then you're just going to have a different credit profile that they're looking at. So it'll start evening out. Just, make sure you have open available credit that is reporting.
So I got a lot of noise outside the house here. They're cutting down some trees, but how long does it typically take for the credit score to increase after making positive financial changes, such as paying down debt and reducing your credit card balance?
It depends on how much you're doing in 1 month. You can really change your credit score, fully in 7 years. Fully in 7 years. Your brand new credit in 7 years, right? But small terms, like on the small scale, if you're starting to pay down the balances, you're going to see positive improvement every month. If you take your tax return and you pay off all your credit cards, you're going to see a huge jump in your score. So it depends on, what you're doing, month to month to improve that credit score. But you can really see, I would work with people from in the home buying world. Um, some people, it might take 6 months to get them ready to buy a house. Sometimes I might work with them for a year and a half, but we can get there over time because if you start day one and you commit to not having any late payments and start cleaning up those collections accounts, you're going to see an improvement every month. So, I saw people whose score might have improved like 60 points in 6 months. Depending on the rate that they start paying off that debt, paying those on time, things like that. But some people it did take over a year. Um, if they were in that lower range credit score, it might take that to get them ready to be approved for a home loan. And again, it is harder to get approved for a car loan than it is a home loan, at least a good rate on a car loan, than it is a home loan. With the home, you've got that security, you've got that house, you've got the what secures that home loan. That home is there, so they have the process of taking that back. Whereas it's a little bit harder with cars. Cars don't maintain their value, so the risk is more. So then the better your score has to be for a higher, better interest rate on the car loans.
Very good. Well, Sarah, I really appreciate you taking the time today to educate us on credit. Personally, I learned a lot, so thank you. And as a reminder to everybody that hung in there, this webinar will be posted on the Akron Canton SCORE website in the very near future, and you'll be receiving a link to be able to view it if you'd like to see it again. So with that, Sarah, thank you.
All right,
Appreciate
thanks
it.
everyone.
Have a
Yeah,
great day,
again,
everybody.
yeah, you too.